All right, it's 4:50 on the dot. Let's get the ball rolling. So we have a fireside chat lined up to talk about capital markets in the med tech industry. It's moderated by the foundation's own Patrick Edelman and Philip Keevil, and I'll let them take it away. Thank you so much for joining.
So pleasure to see everybody again. Thank you for attending our capital markets session. I'm joined by my colleague Philip Keevil from the foundation, and as you both may know, Philip and I work in the FUS Partners group, which is really to kind of think about how we bring the company formation, idea generation into really, into bigger companies. And so that's what we spend a lot of our time doing. Without a doubt, one of the most important parts of that is actually raising money. And I'm pleased to have on as our next guest on us on stage, allow me to introduce Sumit Mukherjee of Bank of America Merrill Lynch. So Shu's been with Bank of America or Merrill Lynch for over 21 years, has spent the last 17 years within equity capital markets. In its current role, Shu is responsible for advising the firm's corporate sponsor and venture capital clients across all industries, but our relationship personally stemmed from when he ran and continues to run the healthcare portion of Bank of America's efforts. He works closely with the partners in investment banking to help guide clients across all of their equity capital needs, inclusive of raising private, public capital, or entering the public markets via SPAC. So in his 17 years as a senior member of the equity capital markets team, Shu has worked over, is 1,500 not the right number these days?
Close enough.
1,500 equity
Slow down this year.
1,500 equity transactions across IPOs, follow-ons, private placements, equity-linked block trades, et cetera. And pretty much across every industry. Most importantly, I get to call him a dear, dear friend. Normally, this is the part, as Shu knows, where I'd probably make a snide remark about him, but I'm going to hold off given the audience and probably take a shot at him sometime later in the conversation. So, Shu, Philip and I are honored to have you here on stage with us, and maybe I'll kind of kick it off with just a broad conversation, just to kind of give a context of where markets are. I think everybody, whether you're in healthcare, whether you're in startup entrepreneurs, is kind of reading and seeing the markets every single day and seeing the emotion and the volatility of markets. And can you give a context of where we are given the past few years of, we ran into COVID, everyone thought it was the end of the world. Suddenly it wasn't the end of the world, and now we're acting like it is the end of the world again. So can you kind of give everybody a context of what's going on in the markets right now?
Sure, happy to. Thanks, Patrick, and appreciate you guys having me here. And good to see everyone. Look, the markets have been everything but like a roller coaster the last couple of years, right? We've experienced the highs. We feel like we're experiencing the lows. And as you mentioned, it's very easy to turn on the news or read the newspaper or look online and get very depressed about where the state of the markets are today. But I do think there is a lot of hope. I think there's a lot of things that we can learn from the last few years that I think will be, very forward-looking in terms of what to expect as we think about, working our way out of kind of some of the challenges we have. On the slide that we have up here behind us, we've kind of outlined some of the bigger issues. If you think about where the market is today, there's kind of three core things that are really impacting the market. One is obviously inflation, which is naturally now triggering the reaction by the Federal Reserve in terms of how they're going to combat inflation, which goes into rates, which is obviously creating a lot of concern. We've lived in an environment for the better part of the past decade with an extremely low to zero interest rate environment, right? And in that environment, it's very easy for investors to take risk, right? Their ability now to take risk as the interest rate environment starts to rise becomes that much more challenged, and I think investors have to be that much more differentiated in terms of where they're going to park their capital. And I think you're seeing that play out on the back of what was one of the most meteoric rises in the market that we experienced, since COVID. And so between inflation rates, concerns of recession, and then you throw in things like the geopolitical landscape that we live in today, the challenges we see with the supply chain, the challenges with labor, there's a lot of different variables the market's trying to price in, which has led to a lot of indecisiveness in terms of making investments, lots of nervousness around parking capital, and given where valuations got to at the height of the market in kind of 21, early part of 21, it was very easy and made a lot of sense for investors to take some of that money off the table. As Patrick mentioned, I work in healthcare, and we were a great beneficiary of that bull market, post the bump up off COVID. Healthcare and technology were areas in which investors really wanted to drive capital into because of the importance of innovation to combat the healthcare crisis, but also to try to do things with as they think about 3, 5, 10 years ahead, how do you invest in these companies today to set them up for great success in the future? And that euphoria of investment into those two sectors, which are two of the largest weightings within the S&P 500, drove these valuations to these peak levels. And what I'll tell you is even as those valuations have retraced, I still believe through the conversations that I have, through the conversations that each of you have, that enthusiasm still exists. I think for them now it's really about learning the lessons of what happened in that move up in valuation, understanding which companies can kind of stand the test of time, and then slowly redeploying that capital. But I think with the macro backdrop we have today, it makes it a little bit more challenging. I think we're not that far away from seeing a lot of these variables come to some sort of conclusion. And the market tends to be forward-looking. And once it prices in all of these risks, I think their ability to bring money back into the market becomes a lot easier.
So there's a saying, prices take the stairs up and the elevator down. We've seen that kind of in the public markets. Are you seeing that in the private markets yet? I mean, our audience here is largely focused on the private markets. Mm-hmm. So have we seen kind of that case correction in the private markets at all?
So we've got a slide on the funding in the private capital markets. And the headline there says private capital markets remain open but are selective. And what I would say is, I think through last year, and again, when we think about the market, right, the market had a meteoric rise after it hit its bottom kind of in mid-March of 2020. Went straight up basically once it found its footing in April till about February of 2021.
So is that so far in 2022, or is it? Yes.
Yeah, so what you see is...
So it's actually quite a high number then.
It's still a high number, and I would attribute that to a couple things. One, the capital markets and the public markets have obviously become a lot more challenging. And so as I think about my own personal backlog for companies we anticipated taking public, all of those companies had to take a pause. But their needs for financing didn't go away. And so they had to turn to alternative sources, and the private capital markets was a great opportunity to do so. But to your question, Patrick, around is the private capital markets seeing some of the impacts of the public markets, the answer is yes. Some of the same disciplines that public market investors are employing as they look to evaluate companies and valuations are being applied to private companies as well, because the valuation comparables in the public markets have obviously drastically changed, and therefore it is starting to reset in the private markets. I also think the threat of an IPO not being as prevalent or more difficult to kind of predict when that IPO market comes back to more normalcy also plays into how investors think about their time horizons on investments and what valuations they need to be compensated for that incremental time before they are able to go public.
Okay, thanks. So if we look at healthcare a little bit more specifically, and you were paid attention to the equity markets, you would have noted that healthcare preceded kind of the downdraft in the markets by a considerable amount. What we've known as the correction has really been this year's issue, the broader markets. But healthcare actually kind of started a downdraft in the middle of last year. Can you kind of walk us through why that happened, what changed in investors' mindsets, and where we are now in the context of things?
Sure, and what I'll do in painting the picture is I'll talk about where I live in terms of the new issuance market and how that in some ways had a role in terms of how the broader markets ended up trading. We put a chart up here that has the Spider Healthcare Select Index, the S&P Healthcare Services Index, the Large Pharma Index, the S&P Medical Device Index, and the Biotech Index. And these are different indices that we look at from a healthcare perspective to just kind of see how various subsectors within healthcare are operating. You'll see the first one to have peaked was the biotech, and that's had the most precipitous fall. And the biotech market peaked in February of 2021, and has been in what I would kind of describe as a winter in some ways, where it's had a precipitous fall. And what drove that peak? It was all the things we talked about earlier, right? The excitement and euphoria around innovation. The amount of capital that was flooding into the healthcare sector, recognizing that this is a sector that the market wanted to help finance to make sure innovation was getting done. What happened as a result of that is a lot of the traditional disciplines within the public market started to kind of get expanded, and people started to stretch in terms of their willingness to take risk and move further out on the risk curve. And we were able at that point, as the market continues to gain strength and momentum, to be able to take companies that we historically would not have been able to take public. So companies were able to come and get met with a lot of demand and interest from very sophisticated investors, in situations where oftentimes they were preclinical. They barely had enough evidence to prove, but what they did have was an incredible technology that people believed in, and I think the thesis around that technology got a lot of folks pretty excited. Now the challenge is, once those companies come public, because of how early they are, there's a long gap between when real data is made, evidence is put forth, and those data readouts are the value-creating events for these companies. And so as the market started to peak, as some of these macro variables started to impact how investors started to think about the markets, they started to take risk off the table. And it was very easy to take risk off at biotech, given where valuations had gone, given the fact that the market's discipline had kind of eroded a little bit. And investors started to sell those stocks pretty aggressively as their rationale to move from growth in orientation into more value in orientation. And so you saw biotech really kind of take a hit first. To your point, the rest of healthcare really started to feel the impact probably towards the middle of 2021. And I think that's as the concept around growth into value became more and more pronounced. And some of the companies that had come public, again, earlier stage than they probably normally would have, started to run into some challenges in the public markets. And that started to kind of be the warning sign for a lot of investors that we need to be more thoughtful about where we park our capital. I think there was that flight to quality aspect that I think investors started to focus on, and you started to see the rotation out of growth into value, and if you're going to remain in growth and you're going to remain in healthcare, into large cap pharma, into managed care, into large cap medical device, where I think investors felt there was probably greater safety and stability versus some of the smaller companies.
I mean, when you sent this chart to me the other day, I think specifically, again, talking to our audience, what caught me by surprise here was how poorly MedTech had performed vis-a-vis the XBI or the biotech index. Can you kind of talk to that point?
Yeah.
Why do you think that happened and where we are now?
So I think device is an absolute area where investors still have a significant amount of interest. So I'll start there, and I think we hosted at B of A a dinner in New York where we had about 15 investors that were medical device specific focused investors doing a roundtable. And I can tell you the excitement and interest to find new ideas and new companies still remains. I think they're all dealing with the challenges of the broader markets, and so I think they're a little bit slower to kind of put capital more aggressively as they did. But to answer your question more specifically, I think with device, there was a lot of interest, a lot of momentum that went into these deals, and there was a lot of IPO, new issuance of great companies that came public in 2019, and then once the markets reopened in 2020, with great success. And many of these companies continue to do exceptionally well. The one challenge is the momentum and the capital that came into the space for a lot of these companies saw their valuations go from IPOing what used to be at a 3-4 turn times revenue multiple, ultimately getting to a place where they were IPOing at 6 to 8 times on 2-year forward revenue. So you can think about how
Saw numbers that were higher than that even.
how aggressive they were going to be, and in a lot of ways setting these companies up to not be able to meet those numbers. And in the markets, there was a lot of capital that was continuing to chase them in the public markets, as they did have a couple successful early quarters in hitting those growth numbers. And you saw these multiples expand, in some cases, from high teens to mid-20s. And so it got very frothy very quick, and I think it made it ripe for investors to take money off the table. Now, I'll tell you, is a lot of those companies today that we had taken public in 2019 and 2020, and I think of companies like Shockwave and Silk Road, Inari Medical, they still trade at pretty healthy multiples, right? So it's still a very good place to be. I think there's an acknowledgement by the market that these are high quality companies with innovative devices that they want to continue to grow. And they're trading kind of now in the 6 to 8 times multiple range. So things have kind of contracted to something more normalized. But what we haven't seen is any real new company formation this year in medical device, right? So there's only been one company, there's only been 10 healthcare IPOs in 2022. Right, to put that in context, there was 225 IPOs and roughly $60 billion that was raised in 2020 and 2021. And so you can see how quickly things have kind of calmed down, and which gives me a lot of time to come and do fireside chats like this.
I feel bad for you.
So the VC, the private investors are sitting on their hands. They're not going to go public at these kinds of prices. Is that what you conclude?
So I think in the beginning of this kind of move downward as valuations started to precipitously fall, I think that was the mentality, because you were colored by the valuations they were able to get. I think as this downturn has kind of lingered and there's concerns around recession, I think there's an acknowledgement that the multiples that were achieved in 2020 and in the peaks of 21 are probably unrealistic, going forward. So there has been a recalibration even in their own mindsets. But what I will tell you is I think many of them are more buyers than they are sellers right now.
Yeah.
I think they're very interested to put capital to work. We spend a lot of time with the private equity community, and they've raised a lot of capital, so they're sitting on a lot of capital. I think there's a lot of interest to invest that capital. But I think as they look at the landscape of companies that are out there across the board, whether it be in biopharma, in medical device, in tools and diagnostics, or even services, what they realize is that 225 companies that were able to come public in 20 and 21, that's not the real number either, right? If I give you another number and I look back at more normalized times, and I look at 2018 and 2019, that period of time you saw 125 companies come public, and that's still a healthy number. And so I think you're going to see the pendulum kind of swing back. I think you're going to see a lot of the companies that are out there still have a lot of interest. I think there's going to continue to be more a navigation around dual path, contemplating going public, combinations. You're going to see M&A pick up in a meaningful way, which we haven't really seen happen, but I think it will.
Can we just step back for a second? So again, trying to somewhat stick to our audience and then build up to that. Often in venture, specifically in med tech, we get a lot of pushback. We get hardware, not software. We get not a long history of multi-billion-dollar takeouts. In fact, I think when I stopped kind of covering J&J, but I used to have this dialogue on, I think they only had like 2 or 3 acquisitions that were larger than $1 billion. And does that resonate? I mean, what do you hear from kind of the venture capitalists when they talk about med tech, when they look at that opportunity? What precludes this from being a bigger space for VC versus, biotech just seems flush with cash. Healthcare IT just seems flush with cash, but trying to get somebody into the med tech world often feels like pulling teeth, if that's a fair assessment.
Look, I think to your point, right, there's a lot of things that need to happen for these companies to hit great success, right? I think with device companies, to really perform in the public markets, there's a certain scale that they need to be able to achieve before they can do it, right? And their ability to not only achieve scale, but continue to grow beyond that at a pretty healthy clip is incredibly important, right? For those valuations to get to where they could potentially be. I think today, the IPO market not being as great of a threat as it was the last 2 years, I think is actually getting some of the larger medical device companies like Boston and Medtronic and J&J actually pretty excited about the opportunities, because I think they are all equally challenged to try to find ways to drive revenue growth. And I think there's a lot of areas within device that fit either as a complementary piece within their portfolio. They have some synergies that they can drive. They have scale from a sales force perspective, because there's a lot of cost to get these things going. And I think there's more excitement today amongst some of those larger companies to explore and build relationships with these smaller, really, really interesting and innovative technologies to be able to bring them in. I do think they have some patience. I think they're evaluating things. You'll start to see, I think, the M&A engine start to pick up. I'd like to say to the back half of the year, but we're already kind of here, really kind of going into next year. I would anticipate M&A being a much larger part of the landscape. And similarly in pharma, right? I think there was a great expectation in pharma that you would see a lot of M&A this year, right? Given how quickly valuations have come. I think there's still a little bit of, to your point earlier, around do VCs want to sell at this stage, there's still a little bit of a spread between the bid-ask, where you have sellers versus where people would be willing to buy. I think people are evaluating a lot of different situations, trying to identify which ones make the most sense. And it's really not, for the larger companies that are looking to make the buy decisions, it's not just about the purchase price, it's about the capital that they need to allocate to it once they bring it in-house. And so those are different things that they're thinking through before those decisions are made.
When you go in with your partners in the banking side, the coverage side, are there any kind of general themes as well that you can identify, any areas of topics of focus for them, be it drug delivery, be it neuro, et cetera, that kind of resonates consistently right now?
Yeah, I think neuro, cardio, drug delivery, a lot of excitement towards these drug discovery platforms as well, leveraging technology like machine learning and artificial intelligence. I think there's a lot of concepts that people are pretty excited about. I think the ones, for device, it's the larger markets, right? Those are the ones that give them the most excitement because they can see the growth potential. There's room for these things to grow. Existing markets that are there, established, sales forces that have the ability to sell them, like those to them are very natural. But neuro is an area that you continue to hear over and over again that people want to get right. And you're seeing that in device, but you're also starting to see that in biopharma as well.
Gotcha.
I was going to just ask you one question. When you say, I think you implied there were about 100 more companies went public than would have been the average. Does that imply that some of those should never have gone public? And
it's not so much a question of should they have not gone public. I think the market backdrop, the interest rates, the macro as well as the micro environment really and the amount of capital that was in the space fostered and enabled many companies to pull their plans forward, right? So companies that were probably thinking about going public in 22, 23, 24 were able to find a home, to find capital, and pull their plans forward into 21. Now, the challenge with that is many of those companies from an infrastructure perspective, from a scale perspective, were not in a position where they were ready to be a public company.
Yeah.
The challenge with being a public company, and Patrick, you know this well, being a public investor, there's really no room, there's no margin for error, right? And if you're making some of those missteps in the public markets and you layer that in with a backdrop that's become increasingly fragile with all the different variables we talked about earlier in the macro, it gives investors a very easy excuse to say, I'm going to sell this now, and I'll have an opportunity to come back and buy it much cheaper. And that's the mentality I think people have been taking, which is why you've seen that rotation of capital from kind of the small and mid-cap space, which is where I make my living, and moved into large cap. But I do think we're kind of towards the, back half of that kind of downturn. I think there's a couple more things that the market needs to price in. And I think that enthusiasm hasn't waned, and I think you'll start to see capital come back. So for those of you in the audience that, have companies that, want to raise capital, I can assure you the investor enthusiasm's there. It's just a little bit of time to get through the macro market.
And that's why valuation is frankly so important. When people overvalue companies and, as you said, such slim margin of error, and then you try and come back and there's this anchoring bias, there's this bias to where I was, what I was. But, I can't raise below that. It's, it's a sign of weakness. So it's why I always say, if you've got a big idea, right, 0% of a failure is still 0, right? If it's a big idea and you still own a decent chunk of it, it's still going to be it should be an economic windfall, an opportunity for any and all to kind of participate.
I totally agree. And I think, again, a lot of the value creation that will occur where you see kind of exponential value creation happens when some of these great events occur when these companies are public, right? If some of these great value creation events happen as a private company, you don't necessarily get valued for it. And I think the higher that valuation gets as a private company, that bridge to becoming public becomes more difficult, and that margin for error narrows as a result of it.
Just to say a little bit about the role of equity research. Are these smaller companies being properly followed? And can they become orphans in the market?
Look, I think there's a number of things that can contribute to smaller companies becoming orphaned in the market. One is going to be their liquidity profile, right? The size and scale of that company also matters in terms of relevance in an investor's portfolio. Look, I think equity research plays an incredibly important role in a process for what I do. And when we take companies public, the underwriting syndicate agrees to take on research and continue to write. And in a lot of ways, they become the narrator for these companies to the public market investors, right? They help educate them around, important nuances around their business, the markets that they operate in, how they make money, and just basically the overall kind of engine that they drive. And I think they play an important role in that. They obviously continue to monitor these companies on a quarter-to-quarter basis. They take investors around to see them and help them understand, what they do. But it's a piece of everything. And I think the sophistication that has happened on the buy side, I think there's a lot of folks that have moved from the sell side to the buy side that really understand these companies as well.
So they don't need
really
the
just about
research.
making sure there's enough information in the market for people to make good and smart decisions.
So just shifting back again for a second, U.S. healthcare market's the largest market in the world, right? Most profitable, largest market in the world. To investors, be it public, private, how important is a U.S. presence, U.S. FDA, U.S. market plan versus rest of world?
It's important. I think there is growing comfort in areas in different parts of the world and regions where I think investors have grown to understand better than others.
Like?
Obviously parts in Europe, Japan. China still is a little nerve-wracking. I think in the current economic climate and everything that's going on geopolitically, that's also become a little bit more challenging and a little tougher to dance, and we've seen that play out in the public markets. Parts of Latin America, depending on the types of investors, there's some understanding around it. But to your point, the U.S. market continues to be one of the most relevant and important markets, and being able to have a presence in the U.S. to be able to demonstrate that you can grow within the U.S., I think is incredibly important.
Okay. You know, with kind of again, with the equity issuance market being kind of wobbly here, we've seen alternatives. We've seen stuff like venture debt get increased kind of perception. Clearly, people are willing to offer that. It seems pretty readily right now. Pipes, can you speak to just kind of the other avenues of capital raising that might exist right now that are out there?
Sure.
And maybe a little bit on the high yield market as well. You know, is that, yeah.
I'm a little less knowledgeable on the high yield market. If I'm
He's
being
an equity guy,
honest.
doesn't understand credit.
But to your point,
Makes
Patrick,
me too.
to your point, I think creativity around how you access capital has definitely become more and more pronounced in an environment as the one we're in right now. From a public perspective, we have kind of shifted gears and have done pipes for public companies. We've done registered directs for companies where you're basically going to a confined universe of investors and having them help capitalize that company without needing to go more broadly. Venture debt has definitely been an option. I think the one thing I would say around venture debt, especially
Can you
for
explain
companies.
venture debt?
So these are companies that aren't making money that are now putting debt onto their balance sheet, right? And ultimately, the risk profile for venture debt is obviously very high. And as those companies who take venture debt on, ultimately come into the public markets, there's different perceptions public-oriented investors will have for companies that aren't making money that have debt on their balance sheet, right? So there has to be a really high degree of confidence that the revenue engine will continue to work, operate, and grow for the foreseeable future, and that there's a really visible kind of sight line to profitability to ultimately be able to pay that down. I think the scrutiny for companies that take on venture debt is definitely a lot higher. Doesn't mean you shouldn't take it, right? And again, not all companies are created equal. And also we recognize in times like we're in right now, you have to be thoughtful about being able to have access to capital to be able to fund that growth, which I do think investors do appreciate and understand.
Okay. There's also just really quickly this idea of, and I'm sure everyone's heard this term, but SPACs. What happened to SPACs? What were they? We saw a fair bit of companies in healthcare and med tech. We saw guys, Butterfly, Hyperfine, all kind of explore that as an avenue of exit, and now SPACs have kind of disappeared. Can you again explain to us what happened as a vehicle and what they were and where they're going?
Yeah, and some of them are having to return money to the investors, presumably. And is there still some money out there that people can?
So for those who aren't aware of what SPACs are, it stands for Special Purpose Acquisition Corporation. And effectively, they're blind pools of capital. They're blind pools of capital that are raised with the intention that they're going to make an acquisition of a target company within a certain subsector. And ideally, those who form the SPAC have some sort of know-how or expertise within the field of companies that they're targeting that they can bring to the combination that should help enhance the company in the public markets. SPACs ultimately became, in 2020 and 21, where you saw peak issuance in that product, to the point where it actually doubled the IPO market in terms of how much capital was raised by these vehicles. They got to a point where they became a viable alternative for private companies to go public, because you've got the shell company in the SPAC that's got capital, you've got a private company that needs capital, and ultimately you announce the acquisition, in some cases along with a PIPE where you bring in new investors, which is your theoretical IPO, and then after a period of time that transaction closes and they trade as a public company. What we've gone on to see, and to your point, in healthcare, there's been a number of them that have come public across both the services and the medical device space, and in some cases, biopharma. Many of those companies have suffered. And one of the things we've learned over time is the shareholder base that has brought the capital in to help raise the SPAC itself in the front end isn't often the shareholder base that would be owning the underlying company.
Yeah.
And so there's a migration of shareholders that needs to occur. That migration, unfortunately, unlike a spin, which we can talk about as well, happens in a period of time where there's really not any depth to that shareholder base. And so that movement out of the traditional SPAC holder and the attempt to try to bring in new capital to be the other side of that trade has been met with a little bit of skepticism. And public-oriented investors, oftentimes you'd hear the phrase, well, if they could have gone public, they should have gone public via an IPO where there's a more rigorous diligence process. And we can talk about the diligence process too, because that's taken a lot of headlines.
And the equity is placed in long-term hands.
Correct. And also we can talk about the role of the research analyst, which doesn't have a role within the SPAC context, but does in the context of an IPO. So there's a lot of ingredients that I would say are missing that you get through a traditional IPO that you don't get via SPAC, that I think has contributed to some of their challenges many of those companies have faced as public companies, in a period of time where getting support from a broader public audience becomes incredibly important. Layer in the fact that we've now come into a much more challenging macro market environment, the necessity for public investors to own many of these combinations has waned, and therefore you've seen a lot of their stocks suffer. So there's a lot of companies that combined during this big SPAC wave that now reside somewhere between 50 cents to $2 a share versus the $10 price that these SPACs were consummated at. And as the wave continued to kind of go and some of the bloom came off the rose with SPACs, the other challenge they were finding is the early combinations, which had most of the money in trust that were raised by the SPAC, actually get into the company. As the market started to kind of teeter, as the bloom came off the rose on SPACs, many of much of the capital that was in trust ended up asking for redemption. So they ended up redeeming, and when you thought you were combining with a SPAC that had $150 million in capital, you're now in a situation where that SPAC, because of redemptions, is only really contributing, $30, $40 million in capital in a good context. And then your need to raise a larger pipe to make up that shortfall became greater in a market environment that became less receptive to those combinations. So it became a very challenging environment. So today, we've seen SPAC issuance decline precipitously from where they once were. To your point, we've seen a lot of the companies that raised SPACs, and they had anywhere between 18 to 24 months to identify a target company and announce that combination and close. Many of those have not been able to consummate transactions, and as such are returning that capital back to shareholders.
So inherently we're all here because we believe in whatever we're doing, the value, the return, the personal joy is going somewhere from the bottom left to the top right. You've depressed, I think, the hell out of us for the past half an hour or so about what this all looks like. So can you give us some bits of optimism, some light at the end of the tunnel when you're kind of looking at where things are going and where they stand from here?
Yep. Look, I personally, despite what we're seeing and reading and hearing in the marketplace right now and what I just walked through for the past 40 minutes, I am very optimistic about what the future holds, right? We know the market has always had up and down cycles. We've kind of reached, or are getting close to reaching that trough. And with that, I think there's going to be a lot of great opportunity, right? As I mentioned, and I think I've said a few times, I think the excitement and interest around innovation remains remarkably high. I think healthcare in particular, which is why I'm blessed to be a part of this industry, is an area that people recognize they need to get right. And it's these companies and people and entrepreneurs that I do believe investors want to make sure they get behind. I think we need a market backdrop that really is not necessarily going up and to the right. I think a stable market backdrop will really foster an environment where people will begin to reinvest. And given the charts that you see up here that are going from the top left to the bottom right, which is the wrong direction, to me, I feel like we're getting very close to that bottom, to the area in which we are going to find some stability. And instability, you're going to see a significant amount of capital return. We're already starting to see that in biotech, which, as I mentioned earlier, started their downward turn much earlier than some of the other subsectors within healthcare. And we are seeing companies still have very readable access to the capital markets. We're seeing data readouts being met with great enthusiasm now, and those companies who have positive data readouts being met with significant amount of capital being thrown at them to help them fund these initiatives. And I anticipate you're going to see that same enthusiasm return back into the medical device market, back into the tools and diagnostics market, and eventually back into the services market. So I actually do think there's a lot to be hopeful for. I do think there's a lot of capital that's still on the sidelines that want to get deployed. And I think once we find that macro market stability, we'll be in a place where that will start to happen.
Okay. If there's no questions, no questions, I don't think. With no questions, I think we'll thank Shu for your time and your insights, and ending on somewhat of an optimistic note.
There you go.
Always wonderful to spend time with you, and thank you on behalf of the FUS Foundation.
I appreciate it. Thank you, everyone.
Thank you very much.
Thank you.
Is the next presentation?
We can just start it because it's a video. Yeah. So we'll just go ahead and do this because this is a pre-recorded. So we'll now hear a special lecture from Dr. Danielle Carnival, the White House Cancer Moonshot Coordinator in the White House Office of Science and Technology Policy. Dr. Carnival leads the Biden-Harris administration's effort to drive urgent progress for people living with cancer, including organizing around President Biden's goal to end cancer as we know it. Dr. Carnival served as Chief of Staff for the original White House Cancer Moonshot and then helped establish and lead the Biden Cancer Initiative as Vice President. She served as CEO of I Am ALS from 2018 to 2021, providing strategic leadership and management to this patient-driven community that is reshaping public understanding of ALS, providing key resources to the community, and creating opportunities for patients to lead the fight against ALS and the drive for cures. She earned her PhD in neuroscience from Georgetown University and BS in biochemistry from Boston College. And we now look forward to hearing from Dr. Carnival an update on the Cancer Moonshot and how the focused ultrasound community can engage in these efforts.
Hello, and thank you for having me. Thanks to the Focused Ultrasound Foundation, Neil, Jess. It's a pleasure to be here. Thank you all for being here today. I want to start off where President Biden and the First Lady so often start, with hope. I don't have to tell this crowd that we don't mean hope in the abstract. We mean hope grounded in science, hope grounded in quality care, hope grounded in keeping families together. Hope represented by every survivor enabled by the work of those in this room. There's so much reason for hope. That's why in February, President Biden reignited the Cancer Moonshot and set bold new goals to decrease the death rate from cancer by at least 50% over the next 25 years, and to improve the experience of people, their families, and caregivers through living with and surviving cancer. This, of course, means investing in research and innovation to develop new ways to prevent, detect, and treat cancer, and making sure that we reach more Americans with the tools we already have. This is possible because of decades of progress. Over the first 20 years of this century, the age-adjusted death rate from cancer has fallen by about 25%, which means more people are surviving cancer and living longer after being diagnosed with cancer. That was enabled by progress on multiple fronts. Treatments can now target specific mutations in cancer cells. We can use our own immune system to detect and kill cancer cells. We have a vaccine, the HPV vaccine, which prevents the cause of up to 7 kinds of cancer. New tools like improved mammograms, CT scans, colonoscopies can detect cancers or precancerous lesions early when there are good options for treatment or prevention. And we have seen dramatic decreases in long-term cigarette use, especially in young people. The Cancer Moonshot mission started in 2016 when then Vice President Biden led an effort to double the rate of progress against cancer, a goal to which so many here and throughout the cancer community responded with passion, ingenuity, and commitment. But despite the progress of lives extended and lives saved, cancer is still the #2 cause of death in America, second only to heart disease. We lose more than 600,000 Americans a year to cancer. 1.8 million families each year are devastated by a cancer diagnosis. The work President Biden launched the final year of the Obama-Biden administration led to the launch of new programs, policies, and collaborations from federal agencies and the private philanthropic health and research sectors and patient groups everywhere. Actions that addressed the patient experience from diagnosis through survivorship. One major highlight 5 years ago with the bipartisan passage and enactment of the 21st Century Cures Act, Congress invested $1.8 billion, providing 7 years of new funding for cancer research in many areas, including studies on cancer disparities, new clinical trial networks to drive drug discovery, and innovative projects examining childhood cancer. The law streamlined cancer-related decision-making at the FDA through the formation of an oncology center of excellence so that effective treatments can be approved faster, and most importantly, patients can have more direct access to information about the regulatory process. That work continued over the intervening 4 years in labs, treatment centers, hospital, community care providers, organizations like yours, and even in the halls of Congress. The Cancer Moonshot from 2016 created a movement that was carried forward by so many. When President Biden took office, he was determined to supercharge the work and bring back his leadership and a whole of government effort back to the Cancer Moonshot. President Biden often says he wants to end cancer as we know it. We took that statement and defined specifically how we know cancer today. Too often, we diagnose it too late. We have too few tools or do too little to prevent it. There are stark inequities in diagnosis, access to treatments and trials, and outcomes. We know too little about how to target treatments to patients. There are cancers for which we still lack good strategies to develop treatments, like some of the deadliest diagnoses, rare and childhood cancers. We leave most patients and caregivers to navigate the disease and its aftermath, including survivorship, on their own, and we don't learn from the experiences of most patients. In each of these areas, we can point to a new approach to caring for patients or a new innovation that can be brought to make progress. We offer this up as a shared agenda, and we know so many of you are already making progress. In addition to a White House initiative, the Cancer Moonshot is a platform to highlight great work contributing to this mission. And so I'm so excited to see the progress being made by the community represented here, to drive progress for patients through the use of focused ultrasound and other technologies, to provide treatments for cancers like breast and prostate cancer, to provide pain management in cancer and beyond, to pair focused ultrasound with existing treatments like immunotherapies to improve the reach and impact of those treatments. You all are doing so much that can contribute to the way that we can end cancer as we know it. Please share your ideas, new actions, and collaborations with us at whitehouse.gov/cancermoonshot. On our side, we formed a first ever cancer cabinet, bringing together everyone from the Department of Defense and Veterans Affairs, Health and Human Services, FDA, and Health and National Institutes of Health, to the Department of Energy and NASA. It's driving a whole of government effort to unleash every possible asset within our power. This cancer cabinet identified priority actions, which will be of interest, I think, to many in this room. 1, to close the screening gap. 2, to understand and address environmental exposure. 3, to decrease the impact of preventable cancers. 4, to bring cutting-edge research through the pipeline to patients and communities. And 5, to better support patients and caregivers. Last month, on the 60th anniversary of President Kennedy's moonshot speech, President Biden spoke from the JFK Library in Boston. He announced new actions from his administration to realize the promise of the Cancer Moonshot to end cancer as we know it. That included announcing the inaugural director of ARPA-H, a new agency that is driving biomedical innovation, supporting the health of all Americans, and addressing health challenges like cancer. Signing an executive order to launch a national biotechnology and biomanufacturing initiative and ensure that cutting-edge biotechnologies and other innovations are made in America, not just invented here, but made in America. And outlined the Cancer Cabinet's progress, including NCI launching a large national trial that, if successful, will identify effective blood tests for the detection of one or more cancers, providing the opportunity for additional, less invasive tools for early detection, and opened a brand new early career grant opportunity, the Cancer Moonshot Scholars, to invest in the next generation of innovative cancer researchers with a focus on developing a cancer research workforce that is more representative of the US population, that pulls from its talents across the country. Announcements earlier this year from the Biden-Harris administration are early deliverables from the Cancer Cabinet to target these priority goals. This includes the Inflation Reduction Act, capping out-of-pocket prescription drug costs at $2,000 per year for Medicare beneficiaries. Because of this law, tens of thousands of cancer patients could see their prescription drug costs go down by thousands annually. The Centers for Disease Control and Prevention issued more than $200 million in grants to advance national cancer prevention and control through cancer screening programs reaching every state, U.S. territories, and tribal organizations. The Environmental Protection Agency, as part of implementation of the Bipartisan Infrastructure Law, dedicated $1 billion to accelerate cleanup at up to 80 previously underfunded Superfund sites, and committed $7.4 billion to help states replace lead pipes and service lines, which will protect millions of families from so-called forever chemicals and other contaminants that may increase people's risk of getting cancers. The Department of Veterans Affairs is now leading the implementation of the Bipartisan PACT Act, so veterans with cancer and other diseases may now be eligible for healthcare and expedited disability claims. The National Cancer Institute announced new efforts to connect underrepresented populations with clinical trials, and the Department of Defense is expanding to all its hospitals a signature clinical research program, the Apollo Network. They're expanding it to all cancer types as well. This is a list among many others. We're doing all we can from the federal government and called on everyone to do their part. But as I said, we're just getting started. Over the coming months, we will feature new announcements from the Cancer Cabinet to show the additional steps we will take to make impact as part of the Biden-Harris administration whole of government effort for the Cancer Moonshot. In addition, and I hope you hear this loud and clear, President Biden is calling on the scientific community to bring its boldest thinking to this fight, medical and public health community to improve outreach to and support for underserved communities to help patients and families have the best experience possible while living with and surviving cancer, and to improve patient outcomes. Calling on the private sector to step up, to develop and test new treatments, to share more data and knowledge, and to collaborate on tools that can benefit all Americans. And respectfully calling on people living with cancer and survivors, their caregivers and families, and those who have lost someone to keep sharing their perspectives and experiences and to keep pushing for progress. We believe that together, building on your expertise and commitment, we can end cancer as we know it. So thank you for the work you do. Thank you for coming together around this really important topic. And thanks for giving me the time to provide an update on the President's vision for this initiative. Really looking forward to hearing the outcomes of your work and more conversations to come. Thank you.
Okay. That concludes the programming for today, so thank you for joining us. It was a packed day. We encourage you to attend the networking reception that will occur now for an hour, and if you're joining online, we do encourage you to interact with other participants on the symposium platform. We'll see you tomorrow starting at 8 a.m. for lively discussion on cancer immunotherapy and technology topics. Thank you.